This is Cece. Welcome to The Orbit. It is Wednesday, January 31st. We've got stocks lower today. That is on the heels of a couple of big cap, mega cap tech company earnings reports last night. We saw Microsoft, we saw Alphabet, we saw AMD. A couple of those reactions have stocks lower today. What's interesting when we're down nearly 1% already is we have the FOMC later where there's no expectations for a rate change today. But what traders will be tuned into is the press conference afterwards. And that's generally on an FOMC day when you see stocks make the biggest moves and you see the indices make the biggest moves. It's actually during that Powell press conference. There could be in the statement itself and the release, obviously people will be poring over that. But the real volatility tends to come in that second part of that experience where Powell is talking and he might give hints about where the Fed is and where their mindset is. So be aware of that. It is at 2 Eastern is the statement release, and then obviously the press conference starts at 2:30. We want to look a little bit at some 0 DTE SPX trading here. And what I'll do is this is at 11 a.m. Eastern that I'm taping the first part of this. And then what I'll do is I'll revisit this throughout the day. It's going to be a wild day, and a lot of people don't like to trade 0 DTE on an FOMC day. We're going to use this as an example of trading with that volatility because I think it's helpful for decision making on 0 DTE, when to potentially put on trades, when to take them off, how to analyze that risk as you might see some decent volatility into the close. So let's start right here and kind of get a look of where we are. You see this gap lower today. We are down near, we're at 4885, down near some of this, we're looking at a 1-week chart, down towards the bottom of this range. Obviously failing in this bullish flag breakout right here. We've failed a little bit. We've pulled back to basically that range we've been in. Going to the 1-month view, you can see where that sort of sits here. Now, what's interesting here is looking at the expected move for the day, we've got a 0.6% expected move, which is obviously a lot higher than a typical day that we've seen recently, where it is more like 0.4% or 0.5% coming in. If this was not an FOMC day, you'd probably see this already at like 0.3% expected move. So it's kind of double what you would typically be seeing at this point in the day. Going in closer, if we were to look and say, all right, well, let's take this momentum of the market down, with this lower point we are during the day, could we potentially look at a credit put spread down at that level of the expected move? And then let's kind of look at it, see the risk reward. We've got about, selling this would be risking almost 400. It's about a 4-to-1, risking almost 400, potentially collecting a little bit more than 100. That'll dance around a little bit as the SPX ticks higher and lower. And, you'll see this maybe go to 100. You'll see it go to 120. As SPX gets closer, you'll see it go below 100 if SPX ticks higher as we watch it. But anyway, about a pretty typical expected move risk reward. We're a little bit over 100 here. And again, backing this out a little bit, you can kind of see it's below last week's lows. And then coming back a month, you can see it's basically lining up. The break even is lining up with that gap higher we saw, right? So pretty decent spot to potentially take a credit put spread. And what you would be looking to do here as a trader is, maybe this rallies into the FOMC a little bit. Maybe, the sellers this morning get a little exhausted and they turn around and they bring in this a little closer to unchanged. The risk of going into the FOMC with this credit put spread on is significant. We could see a bad day turn into a really bad day. So that's what you're sort of thinking about as a trader. So you want to, let's go in and let's put this one on. Now we have we sold it at a 110 credit, our risk is almost 400. And we're going to look at this for the next couple hours, and I'm going to revisit this. If we do see a pop in SPX, right as we traded this, it actually did a little bit already. The timing for this would have been better down here. but I was talking too long before executing it. So we're going to look at this, and then we're going to see if we get an opportunity to maybe put on a credit call spread higher, and then maybe manage it throughout the day where we're kind of legging into and out of condors, having potentially just a credit put spread or a credit call spread at that time or at any given time. If SPX continues lower into the announcement, obviously that would be putting this trade at risk, and we'd be looking at potentially taking it off for a small loss, or we would be looking to ideally take it off for even if we do see that kind of action. If we see it a little bit higher, then we could maybe leg into a wider iron condor than we would have otherwise. Just a quick note on volatility. It's very similar to a earnings announcement going into an FOMC meeting, because what we're going to see is this 0.5% expected move. You're not going to see a ton of theta into the FOMC announcement. It's going to get held, and what will happen is, this probably started the day at 25 IV. You'd see the IV continue to increase going into the FOMC announcement to hold those kind of levels and to hold that straddle from decaying down to where if it got to the point where it was too cheap into the FOMC announcement. Market makers are not going to want to be selling a very inexpensive straddle for the last hour and a half of the day, knowing that it's essentially like the market has an earnings report for those last two. We are back, and it is almost 1 p.m. Eastern time, and we're checking back in on the SPX. And first, let's go to this expected move into the Fed announcement. We've pretty much gone sideways here. And what you can see is we are still at about a 0.5% expected move. And as mentioned earlier, what is typical on a day like today or into an earnings in an individual stock name is this IV will continue to climb to kind of hold this 0.5% expected move. So this IV rising is counteracting what would be typical theta into the end of the day. And that's basically the market maker saying we're going to hold this at around a 0.5% expected move. What we have not seen here is we have not seen any sort of bounce from this where we first put on that credit put spread, and we'll get to the credit put spread in a second. But what we have not seen is enough of a bounce to make it worthwhile to sell a upside credit call spread into this. What we would be ideally hoping for in that situation as a trader is we would like to see a little bit of a rally perhaps into the Fed announcement where the expected move trade or just outside the expected move trade is more up in this range that we saw near the highs of yesterday. Maybe the short strike being the 25 strike or the 30 strike up here. And we have not seen that yet. So right now we would just be holding with the credit put spread with a very tight leash on this credit put spread. Obviously, you can see this expected move into the close takes you right about down to the current break even of this credit put spread. We're sort of dancing exactly where we place this trade. And again, talking about that rising IV, remember this thing is short premium. And so normally, typically, if this had happened in a normal day, this would be at a profit. This probably would be about $75 mark to market for a profit of $35 or something mark to market. Right now, you can see it's basically a small profit or about exactly where we took that credit in. So it sort of didn't matter where you put on this trade because that IV is going to continue to increase into the FOMC announcement. So we'll check back in a little bit closer to the announcement, see if we get that opportunity to sell a credit call spread. If the market continues and sort of gets below this level, if it continues, it's down 0.8% right now. If this was down like 1% into the FOMC announcement, then you'd really have to consider whether it's worth having a credit put spread inside the expected move into that announcement. Now we're back. The Fed announcement is out. We got an initial reaction. You can see here on the chart, this is exactly where the statement came out, and we went lower. We're now in the press conference, and that's why we're seeing this little bit of rip higher based on Powell's comments. This trade, this credit put spread, down here at these levels, it was a mark-to-market loss, but not by a huge amount. Call it $25, maybe at the max, maybe around 30. But at that point, just to sort of paint a picture, the expected move was coming down here and putting this at risk. So it's at this moment, and it's sort of, and you have your opportunities on these pops to get out for even or even a small profit. And when you see that expected move coming down here, that's sort of why you've got to watch that and keep kind of a mental stop. Now with it a little higher, it seems to be in much better shape. But again, this is an FOMC day where you might see some chaos up and down here. So let's look here, and this is obviously something that you could put in a bid to close, maybe a $40 bid, $50 bid, or even like a $25 bid. If you saw that, take off that risk, take that profit and turn that mark-to-market profit into a real profit. But now let's go into, do we have that opportunity to kind of turn this into a condor, which was what we were looking for originally. So right now we've got this upper band of this expected move. You see it's about 0.4% into the close, still pretty volatile, and you see that IV continue to go a little higher. That should fade a little bit once Powell is done speaking. But we've got about a level of 4,920. We were looking at that sort of 4,925, 4,930. Let's go in and check what that 4,920 looks like right now. So this is that expected move. Again, you're going to often see this 4-to-1 risk reward. And that would basically create that, complete that iron condor into the close at about the 25 level. That's a little tight in case the market rips two highs. So if we wanted to go a little bit higher and sort of push this short strike to say that 25 level, right now you're at about 75 risk reward, 75 to 425. Here it's 70 to 430. This might be something where you sit there and you wait for it, and maybe you get that tick up and you can get this off at around that 4-to-1 risk reward up where the short strike is the 25 level. And then ideally, if you had that kind of patience, even taking it up, if this continued to rip a little bit higher, then you get up to the 49.30 level, and you basically would need the market to make a new high on the day. That would be a pretty significant reversal. Right now, this is about 50. This is the type of trade maybe where if it got up to 75 to 425, that extra $5 of room to the upside might be worth it. Let's sort of zoom out here. This is what we're talking about right here with that 30 level. Now, of course, you can just close that credit put spread, like I mentioned earlier, for a profit. Let's go ahead and do this. Let's do this 30 line right here. Try to catch it. Let's see, where are we? We're 4902 in the SPX. Let's see if we get this a couple of points up 49 and try to get this off for a little closer to a little bit more than this. And now we're in this, selling it at 60. We sold it at current is 55, and you can see this right at 4,900. And so we've got this room, and we've got these two trades on, and I'll check back in closer to the close to see how we would manage them, or if any are threatened. All right, well, that didn't take long at all. This is about 10 minutes later after the credit call spread. The market, as you can see, the market reversed, came back down to pretty much where we had entered the credit put spread actually earlier in the day. Mark to market, this thing sold at 60s, now worth 15. I mean, that could be cleaned up, that could be closed, or you just kind of watch it and maybe see if late in the day it goes up to this level, at which point maybe that's a mental stop to take the entire thing off, where, if it broke out above the day's range or even back here, maybe you take it off then, but you're waiting for the last $15 here. Let's go check in on the credit put spread. And here you've got a pretty nice return. There's still about $40, $50 left in this thing of premium, sold at, originally at 110. It's about mark to market right now at about a $65 profit. This one's a little bit closer. You can see the expected move. Again, same thing. If you were looking at this as a risk reward and you wanted that extra $40, $45, this level down here, this low of the day, if the SPX were to get down here and start to threaten this, you'd probably see the expected move putting this at risk. You'd be risking some of this $65 mark to market profits, but holding out for that 45. So it's really a personal decision at this point. If you take the profits, I'll take both off right now. You made about $45 in the credit call spread. You made about $60 in the credit put spread. Pretty good lesson, legging into an iron condor and using the market's momentum against itself, kind of selling the expected move or as close to the lows as possible, which we did here. Remember, we were a little off here. Not the best entry. Here would have even been a better spot. And then we got pretty close to here on the credit call spread side. Now, obviously, everything could have gone wrong in any of these scenarios. We could have seen the market just tank through this, or we could have seen the market continue to rip higher through the credit call spread. Maybe that's the move. Right now, it can be taken off for a profit, but we're kind of, we're right in the middle of this zone between our credit call spread and our credit put spread. In pretty good shape right here if you wanted to hold it and just watch it. But if you want to go out for the rest of the day and not care, you can close these things at a profit.